I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guest I had on a few years ago. Everybody loved him. The only reason why I didn't have him back is just had an embarrassment of bookings, but he's great. And let me give you a little build up to him first off. He is an expert in tech. He was in tech management in high level positions, had his own company, sold it for a mint. He is expert on investment and finance. He used to, before he had his own company, he was an high exec at IBM and Motorola. He also has macro analytics and technical analysis, strategic investment insights. I'll give that again: macro analytics and technical analysis, strategic investment insights. He calls it Matsui. It's matsui.com. And I'm talking about Gordon Long. Gordon Long, thank you for joining us today on USAWatchdog.com.
Well, thank you for having me. That's a mouthful. We just say it's Matsui.
That's okay. That's fine. And you
no Japanese in that either.
Yeah, you are a private investor. I mean, you made a mint off, starting and selling your own company. So you don't want people to call you up for investment stuff.
Yeah, I'm at the stage. I just manage my own money. Though I did private equity and venture capital after I sold my position. So no. So I don't phone me. All our ideas are put at Matsui.
Well, that's great because you don't have any dog. You have nothing to sell. You have no dog in the fight. So just thank you for donating your time to this. I want to start, and I'm going to put myself up here because I want people to read the quote full. It's your quote. It says, you could call it a financialization, creditism, a fascism, a muted form of socialism, or whatever, but you can no longer call our economic system capitalism. You can't call what we have now capitalism. I heard the president of Venezuela say that capitalism doesn't work. Well, yeah, but we don't have it here. So, will you explain that to us?
Yeah, that's exactly the problem. Capitalism works, and it works extremely well. But basically, we've crippled capitalism and have for some time. First of all, you have to understand what capitalism is. It's about companies investing their savings, called profits, into productive assets, which in turn create savings or profits that are reinvested. That reinvestment then improves productivity, which then leads to higher standards of living. That's not what's happening today, and it hasn't for some time, and it's been a slowly gradual shift as we've financialized our economy. And by that, what we're doing now is we create, through credit, we're creating consumption. And consumption is exactly that, consumption. It's not wealth creation, it's expenditure. So you're bleeding the investment capital out of your system. And we're in the United States, a 70% consumption economy. We have trapped ourselves by going that route. And we went that route beginning when we got off the basics of sound money. That is a fiat currency, and it's slowly been accelerating. And in 2000, it was starting to really move, and it actually really crippled in 2008. But we're back on track again. And the exponential growth of credit. And credit today is what's driving growth, is what drives economic growth. Liquidity flows are what's driving asset price direction, and there's a difference. And both of those are now being controlled more and more by the government or the central banks. And as such, that's the problem. You can't have capitalism in a controlled economy. We have something else. My friend Richard Duncan at Macro Watch, he actually calls it creditism, and I think that's pretty good. My friend Charles Hugh Smith, he calls it financialization, whatever you want to call it, but it's not capitalism.
Oh, wow, what could go wrong? I wanted to get this, and I do want to ask you what could go wrong, and it's just another quote. I want to get this in here because I just find it very interesting. This is an unbelievable statistic. Debt today now consumes most of the productive capital being created. I'm thinking, whoa! That is, what happens when everybody turns out like over Puerto Rico and can't pay the debt? What happens then?
And it's coming, and it is, and that's not an exaggeration. And just there's quite a ways of proving it, but not just quick and a back of an envelope. We have $220 trillion of debt in the globe. Let's assume that debt is around 4%. Some of it's historical, some of it's much less right now, but 4%. 4%, 220, we got north of $8 trillion, right, of debt payments. The total global economy, 72 trillion. It's running about 1.8% growth rate. Let's round it up to 3%, double it, almost triple it. So at 3% of 72, we got just over 2 trillion, 2 from A to 6. See the problem? And you can't quite do it that way, but it's close enough. So we're not only not creating any more capital, real wealth, we're consuming it. There's no money left to invest. And the only way you could keep it going is you got to print more money. And that will only work if you have a fiat currency. Before, we couldn't do it. So that's why I look at almost any chart, it's going exponential. The more you do, the more you have to do, because you lose the debt creates less growth. It falls off. The propensity of growth falls off, and that's what we're in. It's that simple. This is arithmetic, not rocket science.
And you can do that when you print a currency. Some people think that you can do this forever, and you can't. You do it until your currency dies, right?
You do it until nobody will take the money, and that's the trick of this whole thing. And so, first of all, you have to understand that 95% of the world's currencies are four currencies: the pound, the euro, the dollar, and the yen. All four of those are the ones debasing their currency at a phenomenal rate, and they do beggar thy neighbor. Bernanke came in, or he actually called it enrich thy neighbor, and that is you go around in a circular fashion so that you really can't see where the debasement's happening. Typically, the debasement's obvious. Gold and silver goes through the roof. Well, many people will argue that that's a manipulated market. But I do know this, that Lawrence Summers was an obscure, former Treasury Secretary, was an obscure professor at Harvard University when he wrote about the Gibson paradox, which is in the relationship between interest rates and gold, and how you had to control the gold money to control the interest rates. And he was plucked out of Harvard and made the Secretary of Treasury, and it's about that time these sort of things started happening. There's a lot of thought has went in to how to control this, and that's what's happening. And the reason stocks are going up, besides the fact we're printing $300 trillion a month, that is primarily the ECB and the Bank of Japan, is that money's actually falling. It takes more money to buy those stocks, except you have no way of measuring it today. There are ways, but most people can't see it.
And some people are under the false impression that you can just keep growing the stock market, creating the debt, buying the stocks, and you can do that indefinitely, and the gold market will be suppressed, and the silver market will be suppressed indefinitely. Is that true?
No, it's not true, but it will go on for a further period of time. We're imminently going to see some very scary moments, because it's again getting very unstable when you look at high leverage loans, when you look at covenant lights, almost any measurement, because the credit market wants to roll over, the business cycle's rolling over. We haven't seen a recession in 8 years. These are all natural processes. I believe, as we see some fear, this whole concept of normalization and quantitative tightening that the banks are proposing is just, I don't know, it's ridiculous. They're not going to follow through on it, even if they believe it. The moment we have fear, they'll be back printing, and we'll have quantitative easing 4, or they'll call it something else. But we will be pumping more money. These balance sheets of the central banks will continue to explode as long as they can control that currency.
So basically what you're saying is that, hey, folks, gold and silver is cheap. At some point, that will revaluate to that will snap back to the real value that it should be relative to the massively printed currency. Am I correct on saying that?
You're correct, and that's the right word too. Is it won't be something that's gradual. It'll be very abrupt. It'll be the system will break, and it's at that point. And James Rickards talks about it, and he's got his hands around it pretty well. That he calls it the big freeze, and the financial markets will freeze up. And when they come out of the other end of that freeze, and it may be a numbers of weeks, because the next crisis will be global and much more complex than 2008 was, where we could control it by the Federal Reserve and various 12 facilities we came out. This one you can't do, and you can't get agreement with all those countries, ever mind understanding the complexity. So when we come out of the other side, it reminds me of Apollo 13 went around the moon, and if you recall, we were all, as a nation, frozen to find out whether they were going to be all right when they came out of the other side of the moon. We'll be in that frozen state. But when we do come out, there will be a massive revaluation in the U.S. dollar.
For everything.
Everything. But
I mean, hold on, I'm going to interrupt. I'm so sorry. We could go into this freeze, and gold's $1,300 or $1,400 an ounce. And when we go around the dark side of the moon and come out and they unfreeze it, gold might be 5,000 or 10,000 or who knows.
Yes, that's the level.
Oh, you think it's going to be that
Oh yeah,
huge?
If they choose to have an element of gold in it, because what they have to do, it's not about gold or silver. They've got to put some stability into the monetary system, and the only way they can do it is having something they just can't print, because that's what's got us in this problem. We have to get back to sound money. Some element will be gold, will have to be gold. It's the only way countries will agree. What percentage will determine what the value of that gold will be, and more importantly, the degree of which the U.S. dollar will devalue. Personally, I think it will be well over 70% devaluation in the U.S. dollar.
That's what it was in 1933. That's what it was in 33. But that doesn't mean
the world's coming to an end. It just means you've got to go through this to reset. Those who prepare and understand why this is happening and watch for the signals, there's going to be fortunes transferred, as there are being right now, frankly, during this event and after the event. But if you're sitting on gold, to me, it'll be just bingo, and it's all the way up. Now, remember, with also not a big caveat, expect the government to tax it like you have never seen before.
Well, of course, then you also, I'd rather pay a tax than write down a big giant loss on my tax form, right?
You're better off worrying about that problem, aren't you?
That's right. And I want to get to this right here, and this just comes into what you're talking about, that it's imminent, but not right this minute. And you were telling me in the pre-interview, you said, well, we're going to get a scare, and that's going to cause them to go cuckoo for Cocoa Puffs with the QE4, money printing, bond buying, whatever. And I wanted to show you your chart here. I'm going to go full screen here to show. Here is, let's just start right here. This is, what is it? This is the 2008 crash. And here we are. Oh, boy, my goodlands. Gone way up. And here we have, it's a delusion that you have circled here. We are here. This was in August of this year. And I guess that delusion has gone up a little higher. We're close to some kind of hiccup, some kind of scare. Is that correct?
Yes, yeah, we are. And everything's so complex, and so many areas are now breaking down. I mentioned the credit cycle. I mentioned the potentials for recession. What we're seeing with just the basic price discovery, assessing of risk, etc. So something will break in here. There will be a fairly serious scare, but that's not a crash is what I'm talking about. But it will be, and I'll use the word, an excuse for the central banks to reapply more money that will be spent.
We're going to get this big downturn. We're going to get some kind of scare, but instead of the chart going down, it'll go up, and then do this big long downturn. This is emotion. This is sentiment, though. The sentiment will crash eventually.
Yeah, and sentiment will take it down. If you look at long-term sentiment charts right now, just pure sentiment, whether the University of Michigan or consumer sentiment, you'll see a massive head and shoulders, and the regression matches the GDP globally that's also falling. So, and the reason I bring it up is if you look at that head and shoulders from the neckline on those measurements, and I post it all the time at Matsui, that is a massive readjustment in sentiment and mood. And that's what will really take this market. Never mind just a normal financial crisis. But I actually see maybe the first scare this fall, but I think the market still has new highs to be made as we go into next year, into the spring.
Because of you've got
a gun to your head right now.
But not because of any fundamentals. Because everybody will say, okay, do something, and they'll do it on their way to completely hyperinflating the dollar.
The dollar, as they print, actually, what we will see is we're going to see real deflation, hyperinflation, and the hyperinflation will come because of the value of the dollar will drop. Hyperinflation, Greg, as you well know, it's not about what you think price at the store. It has to do with a lack of faith in the currency. So when currencies collapse, that's when you get hyperinflation. Your currency won't buy anything. And out of 52 examples of hyperinflation we've had historically, they've all been because of the currency. So it'll be a lack of trust in the U.S. dollar. Big caveat here. When the fear strikes, right now, the flight to safety will be to the U.S. dollar initially. And that's what will drive the market and the rebound in the market, or holding it up, because the money will be accepted. But very quickly after that, the dollar itself will collapse. It'll be the last to collapse.
Yeah, we're talking about some kind of a wild yo-yo, not even a roller coaster, just a boing, boing, boing. We're talking about something like that you foresee coming.
Precisely. You'll call it mass instability like you've never seen before. So everybody will lose if you're trying to hedge in various products or through the freeze. There'll be very few winners if you're if you're playing the financial markets. Your timing will be everything. And remember, everything's working now at computer speeds. Everything's computer-driven trading, etc. It's going to be very tough for the average person to survive with their wealth through it if they choose to really try and play the game in the short term. Sometimes it's better to just buy insurance and set aside. The last 5%, lowest bottom 5% are often the most expensive.
And
So sometimes it's just better to take it, make sure it's well secured, make sure you've got your gold, your silver, you've got cash, and let me say that again, you've got cash, and assets that will stand that. Not all assets are just traded on the stock market. There's a lot of assets that will survive. My grandfather made his money during the Great Depression. He said that was the best time he ever had.
Farm ground, a house title, a car title, new tires on your car, a good battery. I mean, you should have stuff. Is that what you're saying?
Precisely. Real stuff, not digital representations of your wealth that is real right now, but with the amount of third-party risk, and especially and I could get a whole discussion of ETFs right now. It's going to be really questionable whether people the fiduciaries will be able to deliver. You can sue, but they're going to be broke.
I want to come back to this delusional phase here. We're delusional. This is in August. We got to be closer to the top because we sure have. I mean, we got all-time highs in stock prices. We got some places having all-time highs in real estate prices. Other data on real estate shows it's showing off and selling off in many other markets. Then you add in, the crazyville of North Korea saying they're going to let off a nuke in the Pacific Ocean, and the United States has declared an act of war on North Korea, and the president calling him a little rocket man, and just doesn't sound good to me. And yet the stock market is at all-time highs. Is that fairly buttress your claim that we are in the delusional phase in the markets? I mean, this should be all selling off hard.
It's about as clear an example as you're going to get. For those of us who were alive and following closely during the Cuban Missile Crisis and what was going on with the markets and the fear, and this is more serious in my mind. I'm not trying to say what will be the outcome, but the fact the market has not even blinked during this tells you that we no longer know how to price risk. It's not being priced correctly, and we have a lack of price discovery. So the markets themselves have really mutated into something that is not a free market in terms of really assessing value and as an investment of what you'll get on your return. It's almost pure speculation at this point, maybe even bordering on straight out gambling. So, play black six and roll the wheel. That's what we've come to with this level of financialization. And there's a reason for that. And that gets into the buybacks and how the money is being plowed back into stocks. Greg, we were saying earlier before the show that, over the last 10 years, the S&P 500 has paid shareholders more in terms of share buybacks and dividends, more money than they made. More money than they made in the S&P 500 over the last 10 years. 72% of the U.S. companies are not making money. Now, granted, a large number of those are small business being forced out with online and chains and etc., but they're not making a profit. 9% of all European companies their interest expense is larger than their income. These are examples of zombie corporations. How can profits be higher? They're not. How can stock prices be higher? They are. Any valuations tell you they're absurd. So you have to understand how they're holding those stocks up. And it's complicated, but it is relatively straightforward.
They're holding it up with debt. I mean, basically.
Yeah, let me explain it. What they're doing right now is they're borrowing money, that is borrowing it through their bonds, and now they're using other instruments, but they borrow them, they float the bonds, they take the money from the bonds, and they buy back their stocks. Fewer stocks, less earnings, but you're dividing the denominators a bigger number. So all of a sudden your earnings per share are a smaller number. Your earnings per share are up, but your earnings are down. More important, and everybody sort of understand, more importantly, when you have fewer shares, you pay out less dividends in total, cumulatively. And the game today is a global yield chase. So what you want is you want your yield to be increasing, even at 2.5% and negative interest rates around the world. The world wants these dividend paying stocks at 1.75%, 2%, 2.5%. So what you want to do is you want to take the borrowed money, buy the dividends, and increase it a little bit more with even fewer numbers of shares. The yield becomes quite attractive. And I'll speculate here for a moment, Greg, and it's just me speculating. I say, who's buying the bonds? Okay, what's going on here? Well, I look at $1.3 trillion offshore of corporate money, 181 billion at Apple.
Yeah, here you go.
Really?
I'm holding up the your chart here. You have it as unrepatriated offshore money. There's your Apple 181, GE 119, Microsoft 108 billion, Pfizer 74 billion, IBM, and there's a lot of cash out there. You're saying it's not just sitting there.
You're not. Are you really going to sit on $1.3 trillion of the corporations in total? You're going to do something. What can you do with it? Interest rates outside of the United States on bonds are negative. So you say, well, I'm going to hold it at a financial institution. You pay them to hold the money. There's a fee now. You don't get interest on it. So you're going to go invest in another company, and you are a company. Where are you going to put the money? You're what? If I was the CEO, I would have it structured like Enron, not like Enron, but tools that we saw during the Enron. I would have an offshore investment entity, arm's length, that would then buy my bonds. I would use that money to do the exercise I said with the dividends, etc. Then remember, bondholders are paid before any profit is paid. So you got to pay the bondholders, and it goes back into my other account. This is like the spin cycle. This is an opportunity just to completely print money.
The CEO, the people at the top of the company are the bondholders.
Exactly.
So, wow, what could go wrong with this?
Cheers.
What could go wrong with that? What could go wrong with all this buying back and using your own money and all that? This is all the money that Trump wants to bring in from overseas. What could go wrong with that?
Actually, that's one of the, two things can go wrong. One, their cash flow is getting down lower. They don't have positive cash flow, and the EBITDA is draining off, so that means their bond ratings are going up. So that's making it a little bit trickier. But the bigger one is, and I applaud Trump for the policy of repatriating that money. What he doesn't seem to appreciate is, do you think the money's sitting there waiting to come home? It's busy. He needs to ask himself, what's it busy doing? Because no matter what it's doing, there's a ramifications of pulling it home.
Which would be a sell-off in the stock market.
Well, it's my opinion, and it's not sitting offshore. That's my personal opinion.
And I wanted to...
Because I wouldn't be buying those bonds with my money.
You're buying it with company money.
CEO, I would, because it's free money.
Yeah. Got it. And, this thing with gold, with Rickards in gold, you're saying that, according to your chart, and I keep coming back to this delusional thing, you were telling me in the pre-interview, we're close. I mean, this is sending a signal, and whether it's North Korea or all-time highs in stock market or bizarre prices in real estate, and even the Puerto Ricos of the world who, everybody thought they were cool beans when they defaulted on the $74 billion until this hurricane hit, and they need to borrow money. And now you see this is like Mad Maxville, no power for the next 3 to 6 months. It's unbelievable, but I digress. You're saying...
No, actually, you're really on to something very important there.
Okay.
Greg, if you just don't mind me.
Go ahead.
We say in the United States we have a $20 trillion debt. We do not have a $20 trillion debt. We have an $84 trillion debt based on unfunded liabilities and the baby boomers retiring and that big giant Ponzi scheme coming due.
And you're saying right now, not in the future, we have 84 trillion really we're on the hook for right now.
Yeah, we've just went across the cusp. We're now paying out more than is coming in. And that's going to accelerate every single day as it builds up. But the even bigger problem, if that isn't a nightmare, and remember, you've got to print money, that means people got to take it, and go back to our previous discussion, is the debt, it's called the fiscal gap, is 210 trillion. And this gets back to your comment on Puerto Rico. Because what we do in Puerto Rico, when they defaulted, we, the government, guarantee. We don't lend the money. The banks lend the money, by the way, at obscene rates, and they have no risk because we guarantee it. If they default, we pay the banks. So, but we're on the nut for the guarantees. It's called contingent liabilities. We have 210 trillion. So if we have a hurricane, Puerto Rico doesn't have the money. We've effectively got a guarantee that loan that they're defaulting on and any other more money. If the global economy slows down, which it is beginning to, and quite steadily, and it slows down by, I don't know, just a couple percent on that, and we get defaults on that. Even 2% defaults is $4 trillion. We can't handle that. That's how tight this tightrope is right now.
Wow.
So
wow.
So you say when?
That is a small window of error.
It's a snowflake on an avalanche. You don't know which one's going to go. You will never know exactly what the complexity's there. No room for error. So I think when it happens, they've still got tools to at least try and keep this thing inflated. But I'm not sure how long it will go on. The best way of thinking of it, it's like you have a balloon and they're pumping in the balloon, but there's a hole in the balloon. So the hole, they have to keep pumping harder because the hole is the hole in the balloon, but it keeps ripping. So you pump harder, but the rip gets bigger. You can keep doing that, but suddenly all the air starts gushing out of the rip. You don't know at what point that rip just became large enough that the air is going straight out. That's the point we're at. There's a rip in the balloon. We're pumping faster. And will they be able to put a patch on it to buy more time, but they won't be able to fix the rip.
And you said, so when you ask yourself, I thought you were going to say, when you ask how soon is this coming, and you were going to answer, I interrupted you. I think that's where you were going. So how soon is this coming? What do you think?
I think
your roadmap for the next 3 to 6 months.
I think there's a scare coming this fall. I think that in that scare might be a little longer. That scare will allow the central banks to move to quantitative and other programs, helicopter money. They will be in guaranteeing the markets, guaranteeing assets, because they can't have this pension system collapse, and it's all in the stock market. Maybe a little bit, but not much. I think that probably we're talking about the spring of next year. But they may be lucky. They may be able to get it a little longer. But you basically have a gun to your head right now.
And
it's no longer a market.
When you say spring of next year, you're talking about consumer confidence on a plunge next year.
Yes.
You're talking about something that, maybe a couple of thousand points off the market. I mean, we're at 25. I mean, at the S&P is at 2,500. I mean, the market's at, very high, a few thousand points. 3,000 points off this market is like 3,000 points when it was 10,000. You're saying that scare is going to.
1986, we had 20%.
That's right. But you're saying that the scare is going to be something significant. It's going to be an oh my goodness moment.
The scare that will allow the central banks to go to the next stage. Remember, we brought Stanley Fischer in as the co-chair of the Federal Reserve for 2 years. He just stepped down here the other day. Now, one of the most brilliant minds in the world, and you haven't heard a thing out of him. His job was financial stability of the markets. So what did he do for the last 2 years? Well, I can assure you that he's been busy worrying about problems like this.
You think that him stepping down is another ding, 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 the bell's ringing at the top of the... Do you think that's a sign that he's all of a sudden, boom, I'm gone, without any fanfare at all? No cake, no candles, no goodbye party, no gold watch, just boom, I'm out. Bye-bye.
And not because he's fleeing that way. I think he knows what's coming and what it means, and he's just looking at it. He says, my health can't handle that. 24/7 global coordination. It'll take and he just said, you need somebody in here who can handle that. That's my personal speculation, but him stepping down is profound. He is one of the best minds in the world, and they brought him in as co-chair.
And this isn't doom.
By the way, he was a professor for Bernanke and for a lot of them.
And this is not doom and this is not doom and gloom. This is to your point. This is a math problem. You're saying to be forewarned is to be forearmed. Yeah, exactly. Don't believe the happy talk about happy days and it's going to go up to the moon, Alice. We're going to be at 40. It's going to double from here. The stock market. You're saying that you're saying the signs are all there. The bell's ringing, and the I want to say the rats are running. But you're saying that we're getting close to the end. a math problem, a mathematical endpoint.
We're actually kind of part of it in it, and it depends how you measure it. At Matsui, we do have strategic insights. We have 8 of them, and the returns are significant. But what a lot of them are is we're on the short side of the market. We have this capital destruction at phenomenal rates. But what's happening is the main indexes are, because of the FANG and NOS stocks and Amazon, Facebook, etc., are holding it up, and they mirror, as many of our listeners have seen, the central bank's printing machines. But underneath it, if you get into other areas, it's collapsing. One of them that everybody should be aware of is what's happening with U.S. retail space. I mean,
my gosh, yes.
And I don't think people fully grasp the magnitude. 10,000 stores are shutting down this year. What's happening with the chains? And we've been on this, for example, just to show you where the money is being made or sucked out of the market right now. We got in it and believed that the department store model was completely broken. Sears and Macy's and all of them were falling as we went down with them. But then we said, this is going to kill the malls, because they're the cornerstone of all of these malls. And then we see malls, our studies say, and others we talk to, 1,400 malls in America is going to 310 to 400 will be shut down in the next 24 months. So that's collapsing. But then you look at all of the retailers in there.
Toys R Us. Toys R Us is the third or fourth.
Based on malls, especially women's apparels. And these stocks, which are down from 180 to 70, I have troubles figuring out whether they're worth 10. So, and trying to give you an example of the capital destruction that's going on, but it's getting, Toys R Us went broke and this went broke, but every day.
And it's not just everything's going to online. Toys R Us had ToysRUs.com. All these companies have an online presence. It's not like duh. I mean, they all have online, which is mail order on the internet. I mean, So they all, it's like, it can't just be Amazon's killing all these companies. I'm sure they're killing some, but not all of them.
A lot of them are getting Amazon, no question, but that's not really what it is. You said Toys R Us. Why did they suddenly go broke? Have you looked at the debt that they had on their books?
And look, and they went broke before Christmas.
They got the debt, and it isn't because they were bad management. The takeovers load the books up with the debt. Right now in America, over 65% of the S&P are either owned or controlled by private equity. And the first thing private equity do is load the debt on the balance sheet. And then if they drive the stocks up, they try and get their equity out. You got to say, well, who's making all the money on the debt? Because remember what I said earlier, you got to pay the debt holders first. So they're like sucking the lifeblood out. So these companies aren't making any money because they're paying it all to the debt structure that they've been placed in. I don't think Toys R Us are all getting killed by the online. I think they got a pretty good presence and they got a pretty good brand. They're getting killed because of the debt. But when sales start to slow relative to the growth, because you're getting pressure from the Amazons, etc., you can't manage that debt anymore.
That's right.
You just can't.
Yeah.
And we're going right across the board, and we can see it. So there's massive wealth and capital destruction going on right in front of it. We think the auto industry is ready for a cyclical rollover because 1/3 of all cars have been leased. We're going to see 4 million leased cars coming back. It's going to kill the residual values of used cars, and that's why lease rates are so low. So, I mean, I'm just trying to say there are so many phenomenal opportunities to make money, but they're not watching the evening news with the Dow's up.
Gordon Long, you got to go to his site. The easiest way to get to Matsui, if you can't, you just GordonTLong.com. I'll put all the links in at the end for all your YouTubers. Go up to the read through, and I'll say, for all the links there, and after in the USAWatchdog.com, just scroll down to the after the interview section, and just before, I'll put all the links up for you. Gordon Long, thanks. You got nothing to sell, no money to make. You're a private investor. You're an expert in finance and tech, and thanks for coming and putting your brain on display to enlighten some people and give them the real story. Gordon Long, thank you for joining us today on USAWatchdog.com.
Greg, thank you very much for having me. Enjoyed it. Always enjoy it.